Okay, welcome everyone. I know it's going to be individuals that end up chiming in along the way, but again, we have Mr. Gregory Brown here talking about everything from financial planning to generational wealth, life insurance, and more. We're truly excited to have him here for the third time. I know we have other ventures that we're going to be working on with, but we're truly appreciative of the time that he's given us to basically hit us with this knowledge. So without further ado, Gregory Brown.
Hey, I definitely appreciate the warm welcome, Christina. Thank you. So today's, topic is going to be on investing basics. And I want y'all to pay attention throughout the presentation and take some notes down because at the end, we're going to be giving a giveaway. Okay. So without further ado, we're just going to jump right on in. Okay. Now, let me situate that. Okay, so once we get some things out of the way, welcome once again. Definitely appreciate everybody coming out and spending some time. And today, we're going to be talking, as I mentioned earlier, we're going to learn a little bit about the basics of investing. Now, the stock market is a complex thing, isn't it? There's so much information out there, and making sense of it all can really leave your head spinning. I mean, there's really too much to really wrap your head around it. Sometimes the market seems like it'll be flying high, doing well. Everybody's pretty much making money, only for it to suddenly drop and send everybody running, especially thinking about pulling their money out and ducking for cover. Conventional wisdom tells you what goes up must come down. But if you think about the market around as far as like volatility goes, it's a normal occurrence. And really, what you really want to ask yourself is, how tough can you be, especially when it's your money at stake? Because that's what you want to essentially get in your head when it comes to investing. So essentially what I'm trying to do by the end of today is really help you answer that question. How can you feel more confident in the market with your investments, especially with today's economy? So let's try to get a handle on it, right? Some of the fundamentals of investing, core strategies that even the largest institutional investors rely on to get help to navigate, especially the choppy waters of investing, okay? One of the things that I'm not going to try, I am going to go over is really 5 strategies that can change the way you view the market and help you become more confident. So the first thing that we're going to go over is you'll see why the investment strategy starts with the goal is to have the end in mind. Okay. Secondly, I'll explain the balancing pretty much risk versus the reward and why it's an important part of investing. And then third, basically, we're going to learn the components of a balanced, diversified investment program. Fourth, we'll go into why discipline is a crucial part of investment success. And then finally, wrap up with learning how to build momentum in your investment plan. And like I'm with all the other presentations that we had, there's no dumb questions. So whenever you feel a question, feel free to chime into the chat or just interrupt me throughout here. I have no problem with that. Now, these steps are a part of the core values that we here at Northwestern use to invest. What we believe essentially is that expert guidance is invaluable. It's priceless, especially when building a portfolio and the assets allocation that is founded of a diversified investment program. Now, we also believe that there's value in investment fundamentals, the basic principles, such as getting started early, investing regularly, and using strategy that help reduce the impact of market volatility. Now, over time, especially by the end of this presentation, The intention is to help answer most of those questions and provide you a reference that is also pretty much something that you could rely back on here for future use. Now, before we jump into investing, like the strategy portion of it, I want to talk a little bit about the market declines because they're the main reason why people shy away from investing. Now, think back, especially recent times, like last week, when the stock market plunged a little bit. What did your gut tell you to do? Did it tell you to sell everything that you owned? Or pretty much pull your money out of this fund and put it there? Or look for something better? Or was your instinct just to wait and see what happens long term? Now, if you felt a little panicked, understand you're not alone. That's normal for the majority of people that invest. But market dives are natural and like they're common and they're needed. And the reason why they're needed is essentially how the market works is that over time they're pretty much going to perform I guess you could say on a pattern, right? You can see that when you're looking at a single year, a return, like especially for this graph here, it feels like there's a lot of dips and plunges. The market was positive 73% of the time, but it was down about 27%. Now, that 20% is pretty scary, especially when you take into account that it's your own money that you're dealing with. But if you look at the results over a long period, you'll see that things start to look a lot different. Now, over, let's say, a rolling 5-year period, stock market's returns have routinely been 87% positive. That's 14% more than what we were looking at in individual years. Now, while holding on to stocks long term doesn't guarantee that you won't lose money, over a 15-year period, if you were to take, especially now over the last 15 years from 2019 to 2004, stocks have not had a single period of negative returns. So basically what that means is if you take $1 today or even $5, whatever increment that you want to use, and you put it into the market, if you leave it in there for a span of 15 years, you're guaranteed to make money, 100%. No one has ever lost money. And when you think about it in that term, investing becomes so much more encouraging. So market declines are a given, right? There's are ways to mitigate their effects on your portfolio. But the first step is really just to find out what sound strategy you want to pretty much back your goals, okay? What are you trying to do? What are you trying to accomplish? Why are you investing? Some people are investing for retirement, right? For a majority of people, that's what they're doing. Some people are investing for kids' education. Some people are investing for future generations. Some people are just investing just to enjoy their hobbies later on in life. Regardless of what they are, you need to have a goal and a plan to help you accomplish them. But if you haven't decided what you want your investments to do, it's going to be very difficult for you, especially when it gets down to how you're going to define your goals or even let yourself know when you accomplish them. So let's say let me see. Sorry, it just looked like it blanked out a little bit. Boom. Good to go? Is everybody seeing like be specific on the page? Let me see. Chat. Okay, good. So let's say you're dreaming about buying a vacation home, okay, for your family. If you just sit back and think about how great it was to be, if you had a property in the summertime where you could just go to, what do you think your chances are of actually accomplishing that? Not great, right? Simply put, there's no meat to that. But when you make a list of amenities that you want to have inside that property and research the prices of that property in the area you want to buy that property, and then the finances that it's going to take in order to purchase that property, chances are you're going to have a higher rate of success in accomplishing that particular goal. And the reason for that is because when you're more specific, you could exactly plan out exactly what you want, how long you want to essentially accomplish it, and how much it will need as far as like a financial funding to actually get it across the finish line. And when you know all of that, it makes it a whole lot easier to figure out what you need to be successful. Very simply, identifying your goals brings your future into the present, and knowing where you're headed can carry you through the emotional ups and downs. So this holds true no matter what you're planning for. So let's talk about a goal that most of us think about at some point in time, right? i.e. retirement. Now, most of us want to retire. And honestly, that means completely different things to everybody in this room. And that's okay, right? Like I mentioned earlier, some people might want to just stay in the local state that they're in. Some people might want to travel outside the country. Regardless of whatever that is, it's imperative that we remain focused on whatever that is, because all of it's going to require a different type of funding. And basically what I'm getting down to is that the more specific you can be, the easier it is for you to find out what you want to, especially when it comes to investments. Okay? Because when you can figure out what you want your money to do, you're more liable to pretty much do a few things rather. Your goals are going to be measurable, right? You're going to need to estimate essentially how much your dream retirement is going to cost you. And like I said, that's going to be different for everybody. For example, you might want to sit down and take a second to think about, let's say for your retirement, you're going to set aside $500,000. Now, mind you, we should stop and think that it's going to take from a baby from birth to 18 years old, it's going to take on average $250,000. And as we discussed last week, you're going to be in retirement for about 30 plus years. So just keep that in mind when we're thinking about things. $500 is just an example. Your goal also needs to have a time frame. Now, just because you're saving for $500,000 doesn't mean you're planning on retiring at 65. Now, also understand that $500,000 is going to look a lot different to somebody that's planning on retiring at 55. So you should definitely figure out what resources you already have available to you. For example, you might have already started taking out like a 401k at work, a Roth IRA, or even a variable annuity. Now, after all that, you can start to identify little and specific steps that you're going to need to take in order to reach your goal. For example, you might decide to increase your 401k by 15% and then put an additional let's say $5,000 into your variable annuity. Now, we used retirement as an example, but having multiple investment goals is very common. It's also common for your goals to change over time as your life does. So it's very important to revisit this plan annually. Like, this isn't one of those things where we're going to do it at 20 and then revisit it back at 35 or 40 or when we become a real adult. Like, it doesn't work that way. Okay. We just have to do it. So I would recommend that you do it more than annually, but At a minimum, you do it annually. Now, there's no getting around the fact that the markets can be risky. Investing is definitely a no pain, no gain type of game. Okay. But that's why the second step in investing, especially when it's come to investing successfully, is key that you understand risk. This means protecting yourself against risk when you can. And when risk is inevitable, because I mean, let's be honest, it's a gamble most of the time. Knowing how much volatility you're willing to take on is key. Okay. So as we speak about risk, let's talk about risk management. Now, things like car accidents and floods, medical bills, natural disasters could really throw your financial plan for a loop, to say the least. Okay. So no matter how strong your investment strategy is, if you have to stop and use any one of those funds, whether it's a 401k, IRA, variable annuity, whatever it is, if you have to use those funds for something else, that's going to negatively affect your ability to reach your goals. For example, if you were injured and let's say you didn't have medical insurance or enough money to cover that expense in your emergency fund, you might have to reach and dip into your 401k to pay for that unexpected hospital bill. Now, understand, once you recovered, you'd have to build up those funds back to where they were originally before the injury. And if you missed work because of that injury, understand now you got to cover the costs of those expenses too. So it just makes sense to protect yourself. Get insurance to cover the risk that you can, and then build a solid, comprehensive financial plan that has emergency funding and unexpected contingencies already planned into it to help you get past any of those bumps that life can throw at you. And then you combine all of that to essentially establish a strong foundation of risk management. And that's your investing strategy. Now, anytime you invest, there's risk involved. Nothing's a sure bet, but everyone's tolerance for risk is different, and that's okay. Now, there's no right or wrong answer when it comes to risk. Absolutely none. At Northwestern Mutual, what we try to do is we use a personalized approach to it with what we call the investor profile. And basically what that tool is, it helps us get to know what our investors' risk tolerance is. And some of the things that it looks and takes into account is your investment time frame. Basically, how long you will need to invest that money before you need to start essentially dipping into it. And then when you're ready to start using those funds, how long will you be making withdrawals? That time frame is called your withdrawal time frame. And then how much of your money is essentially going to be rolled up into pensions, life insurance, personal savings, or other fixed assets. Now, typically, those are considered more stable. And for other questions too, like helping you figure out essentially what your personal liquidity is, your income stability, and how you feel about the overall market volatility. Now, understand how you answer these questions are really going to help you piece together your own personal risk tolerance and what that means for you as far as investing. It also gives you more confidence when evaluating your options. Now, knowing how much risk is, sorry, I had an email pop up. Knowing how much risk or volatility you're willing to accept is really going to be part of the bigger picture. Now, basically what this is that it helps you recognize essentially what the returns are going to look like on a lot less volatile when you view them over a longer period of time. Now, that's because over a long period of time, periods of high returns tend to be offset periods of lower returns. And typically that's how they work. Like, as you can see in the picture here, uh, you're not always going to have the best of the best years, but you're also not going to have the worst of the worst. Now, with this chart, it pretty much shows you how the S&P 500 performed over each decade since the 1950s. Okay, if you look at each decade separately, there's a lot of dips, but in 70 years or so, the S&P 500 has ended the decade with a negative return. That's only happened once. And as you can see, the following year, it's positive back again. And then essentially the trend is for the market to increase. Now, you can see that even though the market does drop at times, staying invested over the long term helps reduce the risk of loss in the long run. So, we've talked about identifying your goals and understanding risk. Next, what we're going to be talking about is diversification. Now, today's investors have a huge number of options to choose from. Different assets, investment vehicles, all from hundreds of financial providers. And where you invest your money depends on essentially what you're trying to achieve. Your risk tolerance and how long you're going to be investing, and what investment options are available to you. And to its core, what diversification is basically splitting up your investments into different assets so that you're not putting all your eggs in one basket, so to speak. Now, finding the right combination of different investments to meet your goal in a way that suits your unique investing needs. Now, before we dive into asset categories, is there any questions so far? No. Okay. Now, it's not a trick question. Asset categories, or allocations rather, is exactly what it sounds like. Basically, it's going to be how you allocate your assets or split them up between different assets to create a diversified portfolio. Now, it doesn't have to be complicated in order to essentially work, but it should at least include 2 asset categories to be effective. Okay, and that's because each asset category has something unique to contribute to your plan long term. Now, equities such as stocks typically offer the greatest long-term growth potential, but they also have a higher level of risk. Okay, fixed income securities have other benefits and other detractors, basically the pros and cons of that. Now, bonds are a good choice for income, while cash alternatives such as like money market funds provide liquidity and stability compared to other asset classes. Now, money market funds are designed to preserve the value of your investment as per every dollar, or better yet, every dollar per share rather. But unlike some other fixed income securities, they're not insured or guaranteed by the federal government. The whole FDIC, the Federal Deposit Insurance Commission, or corporation rather. So basically what that's telling you is that you could lose all your money by investing in them. But as your investment portfolio grows over time, you can consider broadening your asset allocations too. For example, the United States stock market is comprised of small, large, and medium companies, each of which can be further subdivided into their own little growth or value categories. The same is true for bonds and cash, but they can be categorized by investment grade, maturity sector, or tax status. Now, it seems the market are going through a rough patch, especially in today's market, right? It seems like every other week the market's up, the market's down. But there's always some people that pretty much make away with losing a lot of money, and with that, a lot of confidence. And then there's people that essentially basically skate through unscathed, you know, regardless of what the market does. You know, they seem to be untouched. So you got to ask yourself, like, why is that? And it's not just that some investors are lucky or know some type of secret that gives them an unfair advantage. Those investors who do well understand that diversification and essentially asset allocation are key. So, as I mentioned earlier, different asset classes have different benefits and drawbacks. They tend to react differently to economic activity and market trends. So combining them can help provide investors with a balance between expected risks versus the rewards, or better yet, known as returns. Now, sometimes stocks returns pretty much when stocks go up, while bonds returns are down, they have like an inverse relationship. Okay, so when combined, the offsetting movements help to reduce the overall portfolio risk. So when your bonds go up, you're going to see a drop in stock prices. So the asset allocation models shown basically represent the possible combinations of stocks and bonds. Even though bonds are considered less risky than stocks, notice that even the most conservative risk portfolio has a mix of different asset types. Diversification is key. Now, historically, a well-diversified portfolio has a lowered risk and increased returns. Past performance offers no guarantees of future results, and that's key. Like, whatever you put into the market, understand you're taking a risk, okay? Finding the appropriate combination of stocks and bonds for you involves knowing your risk tolerance and return requirements. Any questions so far? Okay. Now, what we see here, this right here is really, we like to call it the quilt. Now, basically what this is showing us is that even though there are a lot of clear advantages to diversification and asset allocation, many people's portfolios represent a hodgepodge of investments. And pretty much that's based on like hot tips or last year's performance, rather than their own ideal goals and individual goals. Now, if there was one asset class that, let's say, led the market every year, that might make sense to, go off of that type of, theory. But markets are changing all the time, making it impossible to predict essentially what class is going to outperform or be the worst this year. Now, each color on this chart represents a different asset class. You might think that there are some that look really, really good, like that bright red one, on the top far right, or better yet, far left-hand corner, which represents international emerging markets. Okay, represented right here, this one. Okay. Now, it looks like it's at the top a lot. I get it. But take a look at where it shows up for the rest of the years. Now, don't get me wrong, it does perform fairly well. Don't get me wrong. At the top at 2007, 09. But if you look down to 2008, it was at the very bottom. And on 2011. And then right back up at the top on 2012. And then down near the bottom at 2013, 14, and 15. Now, based on all that movement, as you can look across the chart, essentially, how can anybody really predict what next year's winner is going to be? It's nearly impossible. You can't do it. But when assets classes move in and out of favor this quickly, trying to shift money around so that you're only investing in the top performers rarely works. It's better to approach this with a diversified portfolio that we've been talking about. And basically what that is represented by is these white squares pretty much scattered throughout the middle. Okay. Now, you can see that it's a pretty solid performer all the way across. And that's because it's not relying on just one type of asset class. Of course, diversifying your portfolio means that all your investments won't be the best performers every year. Okay. Sorry to say that. But what I am happy to say is that it also means that it won't be the worst performers either. And by developing a balanced investment program, you can reduce some of the volatility associated with changing markets. The next step that can be the hardest for some people is going to be discipline. We just talked about how timing the market isn't a great strategy, right? But it's not surprising that investors are still emotionally tied to the choices that they make. Jumping in and out of investments in hopes of getting the best returns. But let's be honest, no one wants to lose money, even in the short term, okay? But take a look at this. This chart shows how missing the best days in the stock market over a 20-year period can affect your returns. Being invested the whole time, just gives you over about a 4% return, which isn't bad. By no means an imagination. That's a great return. But if you try to time the market and end up missing, let's just say 10 of those best trading days throughout the year, that return drops to almost zero. And if you miss 20 or more, at that point in time, you could be losing money. So just think about that. By trying to avoid market dips, you could easily miss out on one of the great days as far as the market goes. And that can have a big impact on your portfolio over the long run. So when you start to see the market shift and you get nervous about your investments and start, like sweating, understand it takes discipline. And sometimes a lot of discipline to sit here and try to resist the temptation to pull your money and put it elsewhere. It just takes discipline to sit back and trust that over time, your diversified plan will do the work it was designed to do for you. Now, compounding is when your assets' earnings are reinvested into the portfolio. And understand that can make a very big difference over time. So in this chart, we got 3 hypothetical people who each invest $6,000 a year in a stock market that has about 6% as far as like a rate of return. Now, with all the income from those stocks being reinvested, basically, you'll notice that how much the investors have by the age of 65 is very different amongst all 3. And that's because when they started investing makes a huge difference in how much is compounded over time. Now, investor A, pretty much represented by the yellow line, starts investing at age 25 and keeps that investment up pretty much all the way through age 65, providing a full 40 years of investing and compounding interest. Investor B, represented by the blue line, also starts investing at age 25. The only difference is he stops at age 40. That means there's only 15 years of investing, but he keeps the compounding for another 25. Now, the last investor, investor C, represented by the gray line, this guy right here, pretty much invested from the age of 40 to 65. Now, that's a full 25 years of investing and a total of $600,000 more invested than investor B. However, with less total investment and fewer years contributing, investor B ended up with over $300,000 more than investor C. Why is that? It's because starting earlier allows interest to compound over time. And like I mentioned last week, time is the key factor. Even after you stop making your contributions, time is what's going to build it. Now, it's important to note that these numbers here typically don't include taxes or transaction costs. Like, of course, since stocks can be more volatile than other asset classes, return on principal invested in stocks is not guaranteed. And that's just pretty much the name of the game. Now, the fifth step is pretty simple, and that's just let your plan build momentum. Now, let me ask you a question. How many of you exercise? Does everyone pretty much exercise? Nobody? No? Well, I know I mean, every now and then it's a struggle for me too. But let's be real. What I found out is that as much as I may hate essentially waking up early, going, working out, getting suited up, I always feel better when I do it. And there's essentially the more I exercise, the more energy I seem to have. And the more energy I seem to have, the more likely I keep on essentially exercising. Now, when it comes,
sorry.
I'm sorry, go ahead.
I was gonna say that like with working out, it's just so hard to start. And I think that's what everybody or a lot of people have issues with. So I actually was proposing a question. So because right now it looks like we have a lot of young faces on here. So for those who are in college or recently graduates who are interested in investing, so I guess 18 to 25, because you talked about if you start early, what would be something, I know last week we talked about annuities, but how would you say or what advice would you give for them to start investing now? Would you say in like if they're not working, it wouldn't be a 401k, but like a CD or a savings account? I know interest rates suck right now, but what advice or what would you propose them? So if they have refund checks or they're just recently getting out and they're interested in starting investing, what would you recommend?
Okay, great
to get that
question.
momentum going?
Yeah, absolutely. So that's a common misconception that you have to have a job in order to start a 401k. That's not the case. Understand, a financial professional could set that up for you. Now, your employer could set one up too. So essentially you could have two. And there's really no number of how many 401ks you could have. Same thing with IRAs. Now there's some limits as far as contributions, but you can have as many as you want. Now, some advice that I would give a college kid or even somebody like a young professional starting out is try to picture yourself in the future. Like if you're 20 to 25, try to envision yourself at 30, 35. What do you want to have accomplished by that time in your life? And then start investing for those goals, right? Understand your time horizon doesn't have to be all the way to retirement, right? It could be 3-5 years down the road, and that's okay. But just understand that if you want a large number in that short time frame, you're going to be exposed to a lot of risk, right? Because without risk, there's no reward. So, and mind you, it doesn't have to be a lot. Like we went over in the last slide, a couple slides ago, this one right here, right? The individual that started at 25 didn't have to contribute nearly as much as everybody else from his pocket. Compound interest just blew his year earnings out of the water. And it's the same thing that's going to work for a college kid. Just understand what it is that you want to get and envision yourself in the future. And then from there, just attack it. And like, there's plenty of apps out there, whether it's Acorns or Robinhood or, like there's a variety out there that will get you introduced into the market. But if you don't like doing like e-trades and actually tracking all that stuff, I mean, my contact information is definitely at the end of this slide, and we could definitely sit down and chop it up, and we could put things in place for you. That's too easy. I mean, that's what I'm here for. But that's what I would recommend to any college kid going out. And not to beat a dead horse, but understand college is going to end. There's going to be a time in which, those loans are going to have to get repaid back, regardless if you have a job or not. So um, it's never too early to start.
I also have a question. Sorry.
Mhm. Yep.
So from my understanding, when I left my job,
Mhm.
I let my 401k sit there.
Okay.
I kind of don't know what to do with it. And I just don't, just because you know better doesn't mean you do better, but I don't know what to do with it. And I know it's at a moment where I could borrow against it and use it for something, or I can roll it over. What would be your recommendation of what I need to do? Because like at this point, I assumed that it was actually collecting interest. But they're stating that it's not. Well, I've heard a lot of things. So I just pretty much don't know what to do at this point. And maybe I might have to call you after this. Now we're thinking about it, but I'm sitting here with my 401k sitting somewhere that I don't even know if it's earning any interest or not, um, because I no longer work at that company.
Okay.
So what do you recommend?
So just so you know, your 401k is going to be earning interest, but without your contributions, it's not going to grow as fast. Um, so what I would recommend you do, especially if you want to have hands-on and like just have fidelity on what's going on with it, is definitely rolling that over into either a 401k that you establish yourself or through a financial professional. We could definitely do that. That's too easy. Um, and I would challenge everybody to get a better sense of where their money is. Like the last thing you want to do is have funds essentially in the pocket of somebody else, especially if they belong to you. Like you worked for that, you earned that. But um, as far as it earning interest, it's definitely earning interest. But if you stop contributing to it, it's not going to grow as fast. But yeah, we could definitely sit down and chop it up. Like that's too easy.
Sorry, I have another question.
Yeah.
So when you start a 401k or roll it over to a 401k that I will start, will will my new company that I work for, would I be able to set up 401k matching with that one? Or that's only through my job? And then two, if I have two different ones, like one for my job and then one that I've started by my personally, is there a max amount that I can put in each, or is it a total amount that I can put in each year, if that makes sense?
So when it comes to retirement accounts, there's always going to be caveats, right? Um, like with IRAs, like especially if they're Roth IRAs, they cap it at like $6,000 that you can contribute to. 401ks, I believe it's like 19.6. Uh, but it all depends on essentially what it is that you're going to. Um, but as far as matching, yeah, that's going to be an employer benefit. Um, but understand it doesn't stop you from, let's say, getting two um, 401ks, IRAs, or what have you, and still contributing the same amount if you want to get the matching down. But yeah, all that stuff is really more so. It's really going to be in line with what you want your accounts to accomplish, right? And your time horizons with those accounts. So if you want to have like your 401k be like a retirement nest egg, um, then yeah, I would definitely roll over, especially if it, because what you don't want is you don't want to have like several small ones that you started sporadically throughout time at different increments, because that's just going to affect how much compounding interest is going to be contributed to each one, right? So uh, by all means, I would say have your own, and then from there just ride that out. And if your employer offers you like uh, a matching contribution benefit, definitely take that, because that's just money on the table. That it makes no sense to leave that, right? So that's the only thing that I would, uh, as far as like suggesting, as far as getting another IRA outside of your own, or even 401k. But like I said, having too many can't hurt you. Um, Unless you're looking to have a short time horizon.
Thank you.
Hey, not a problem. Any other questions? And like I said, we could definitely chop it up afterwards too. Now, when it comes to reinvesting, especially when it comes to your investment earnings, it's pretty critical to sit down and talk about how essentially it creates the same type of momentum when in retrospect to going to working out, like those earnings that you're able to reinvest into your 401k, your IRA, whatever investment vehicle that you have, pretty much propels that all the way through to its essentially to its maturity, quote unquote. Now, that's because when you allow your dividends to essentially compound over time, your investment is building earnings essentially at a more accelerated pace. That's a perfect word for it. Now, income producing investments are key to this approach. They can help keep your investment plan on track even during market declines. Now, why is that? Historically, many companies have essentially kept paying dividends at the same ratio, no matter what the market is doing. Now, bonds and money market funds also provide a steady stream of interest payments, which can cushion your portfolio during periods of market volatility. And that's kind of why you don't necessarily want to have essentially like every employer just have, whoever you are employed with have a 401k. And it also kind of chimes into why that account is continually to build interest, right? Because your employees, even during a down market, they're still contributing to it, paying the dividends. Now, reinvesting your income is pretty much a key component to boosting your returns. Now, this chart essentially compares the hypothetical growth of $1,000 invested in 20 stocks, and bonds over a 20-year period. Now, you'll see that some of these bonds and stocks are with and without reinvestment. Now, reinvesting allows you to capitalize on a lot of compounding, which essentially means that you earn income on the principal investments in addition to reinvesting the dividends and coupon payments. Now, if you compare the stocks with the reinvestments to the stocks without the reinvestments, you can see that the returns on that $1,000 are about 2% higher if you reinvest. Now, with a $1,000 reinvestment bond, it's 4.3% higher if you reinvest. So whether it's stocks or bonds, reinvesting that income can help you maximize the growth of your portfolio. Just keep in mind that total return represents capital appreciation, income and investment of income. And as mentioned earlier, government bonds are guaranteed by the United States government, okay? While stocks are not guaranteed. Thus, they're more volatile. Now, those 5 investing basics help you pretty much stay on track despite the market's ups and downs. And I know I've covered a lot today. So let's take one more look at those 5 steps. Step 1, essentially what we're going to do is we're going to identify your goals. We got to be specific, like pinpoint. Write them down, quantify them, be specific as much as possible so you know exactly what we're working towards. And then step 2, essentially protecting yourself against risk where you can, and know yourself as an investor and understand the role risk plays in helping your investment strategy. Now, step 3 is building a balanced, diversified strategy, one that can help smooth out the bumps when it comes to essentially investing. Step 4, we're going to give your plan essentially the time to work. Regardless of what happens in the market, you have to stay strong and just trust that your plan is diversified enough to accomplish what it is that you want it to. And then finally, we're going to let the momentum build. Strategies and compounding and reinvesting can help you speed up your way to accomplishing your investment goals. Now, understand there's a lot of information out there. And let's be honest, there's a lot of noise too. But when it comes to the market, even when you feel comfortable with the basics of investing, it takes time to actually make sense of it all. And understand it's difficult to be sure that you're making the right choices and essentially being successful. But honestly, that's where I could provide value. Working with a financial professional, essentially someone that takes his job seriously and essentially has the duty and responsibility to know all the concepts we've essentially went over, talked about, and more. You want someone who's objective, who can help you wade through all the information out there, create a sound investment program to grow and manage your wealth, right? And in addition to all that, pretty much just incorporate all that into a strong financial plan that helps protect what you care most about. And then someone who's committed to providing you with the continuing support, basically helping you stay on track and goal oriented and minded so that you can accomplish those goals as you pretty much your life changes. Put the market events into perspective so that you can maintain your focus and essentially just ride that out through all the market turmoil. Now, understand, just as this is, it's important to trust the financial representative that you'll be working with. It's also important to ensure that that individual is essentially representing a reputable company, standing behind them. One that's pretty much stood the test of time and has your best interests at heart. Here at Northwestern Mutual, we're ranked among the top 10 as far as investment brokers go, independent brokers, dealers. And as you can see, we're the top, among the top, when it comes to leading investment industry publications. We've been helping clients reach financial security for over 160 years. And needless to say, we got this. We've been doing this for a while. We know this. And we've got the highest financial rating amongst any life insurer from all 4 major credit rating agencies. Okay. We have well over $132 billion in assets under management. And year over year, our clients are 96% chance that they're going to stay with us. So understand that says a lot as far as our dedication to always doing what's right for our clients. So in conclusion, definitely thank you guys for being here. And I hope that discussion has helped somebody, especially when it comes to the basics of understanding investments. And hopefully it also motivates at least one person to start looking into investing and how it can help them essentially set themselves up for success. Now, as a Northwestern Mutual financial representative, it's my mission to essentially provide guidance to all my clients so that the life that they envision themselves having becomes a reality. Now, like I said, there's no dumb questions. Do I have any investments? Yeah, absolutely. Great question. So one of the investments that I can't sit here and say more or enough about is you need to invest in yourself first before you start looking outward, right? Because it makes no sense for you to essentially get a 401k, get all this stuff if you don't have you or invested in you. Whether that's life insurance, an emergency fund, disability income insurance, just you got to have the foundation set so that everything else could be built upon it. So yeah, I have plenty of investments. I have not only life insurance, disability income, but I also have 401ks, TSPs, Roths, just a well-diversified portfolio just to ensure that, in a nutshell, the life I want to have in my head is one that I can actually play out in reality. So yeah, I would challenge everybody to at least look into it. so that it's not just a dream anymore.
Earlier, you spoke of not having small, like smaller, different, like 401ks or different investments, and you have like a very diverse portfolio when it comes to investments. When would you say is too much, or when we need to condense down or expand, or just kind of do like a investment checkup?
So honestly, what I would say is, let's say if the market was to dip, like crash, and you would feel it, that is a red sign that you are not diversified enough. You are too one-sided. So yeah, if like, let's say for example, if you have only one stock, let's say Walmart, right? You're invested in Walmart, and Sears is doing really well and Kmart's doing really well, but for whatever reason Walmart tanks. You're going to lose all the money that you have invested. But if you invested in all three of those brands, and let's just say Walmart falls, but the other two are doing well, you're not going to feel that hit. So as far as being well diversified, if that market tanks and you feel it, and I'm not just talking about like a couple, like if you feel it enough that you can't sleep at night, that's when we need to start talking as far as getting more diverse. Good question.
Thank you.
Mm-hmm. And understand it's not. I'm sorry.
Oh, my question is like, where is it? What's a good company to start investing in?
So that's another thing, right? Like starting in where to start is the biggest key. It's like the biggest hindrance. Like nobody has a blanket answer. Like there's not a safe answer, right? Basically what it is that you need to identify what your goals are. And like for instance, if we were talking and you told me, hey Greg, I want to invest in some things. One of the things that I would ask you straight up is, well, what's your goals? What's your purpose for investing, right? How long do you want to invest for? What's the money going to? What's the intent behind that? What do you want that money to accomplish, right? Because if you're looking to buy a house in 5 years, that money that you're putting towards your house should not be the money that you're investing. Understand, the money that you're going to be investing is money you're willing to lose. Okay. So if you're looking to buy a house in 5 years, I would recommend that you do something more conservative, such as whether that's life insurance or, a TSP or even a Roth IRA. I wouldn't necessarily go like stocks or, well, maybe bonds because they're a little more secure. But like I said, it just really depends on that individual. And typically what I would do is especially if you're younger or you just have you just don't know where to start, what I would recommend is that you look into mutual funds. And basically what mutual funds are is they're buckets of thousands of stocks and bonds. And basically what it is kind of like how, if you refer back to that quote that we saw with all those different colors, that's what a mutual fund looks like. So that in the event, one stock or bond is doing poorly, the others aren't. So you're protected because you have that diversification already built into it. And it's a single payment. So it's not like you have to pay thousands of dollars in order to do that. Aside from like the initial payment, ours is like, it's fairly cheap. So that's what I would definitely recommend you do, is look into mutual funds. If you're just not sure, that's a safe way to go too.
Investing in.
Well, how old's your son, sir?
He's 5.
So for him, honestly, what I would do is I would get him a whole life insurance policy. And the reason for that is that those things are based off of time and health. And honestly, like that's something that he's not going to be able to buy for himself, no matter how much he tries, because he can't buy it at 5. You could get it for him at 5. And that's something that he's going to have for the rest of his life. And what that's going to enable him to do, depending on, the size of the policy that you get him, it's going to provide him a it's going to provide him an additional revenue stream outside of whatever it is that he's already doing. Like case in point, my son, I bought one for him when he's 2. And when he turns 18, the amount of money he's going to be given in the form of a dividend every year is going to be enough to send him to college. So like, understand that's only going to work because I got it to him when he was young. And it's a lot cheaper when you could do it like that. So for him, I would start off that. And then from there, maybe even looking into, we could do IRA. It all depends, for your son. But that's one thing that I would definitely recommend for him, especially if he's under the age of 18, is a policy. If I only have a small amount of money, is it still worth it to invest? Oh,
Gotcha, thank
absolutely. Yeah, not a problem, sir. So when it comes to investing, understand it's not the amount of money that matters. It's the amount of time that you're going to have the discipline to let that grow. So understand if you have, and it's the commitment, it's the consistency. So if you do, I would much rather you do $5 a day than $100 every month. Okay. So yeah, it doesn't matter how much money you have. It's the fact that you start and you continue to do it. You build the habit, because that's going to generate, remember, the compounding interest. So it's just going to build on itself. And understand, in order to get to 1 million, you're going to have to start with 1. So just keep that in mind. Great questions. Anything else? All right, nothing heard. Okay. So basically, this is my POC, my point of contact. Feel free, that's my cell phone number. You could text it if you want. That's my email address and the website. So if you want to find out more information about me or my team and some of the services that we provide, definitely reach out to us. And like I said, our consultations are free. The only thing that you guys pay for are the products that you want to implement. That's it. So if you want to do life insurance, if you want to do disability, if you want to do long-term care, investments, that's the only thing that you're going to buy. Okay.
One more question, sorry. So for those who are interested, because it looks like it's individuals that are interested in investing, what do you all like? What's the lowest amount that an individual can start an investing, like investment portfolio or some kind of investment product with you?
So if we're talking like 401ks, IRAs, and things like that, understand it. So the first payment's always going to be the biggest mandatory one. So it's going to be $250 right off the rip, and that pretty much that'll pay for the fee. And so that's another thing that you got to look into is the fees. So when it comes to like 401ks and IRAs, they all have different fee structures. Now there's some fees that like upfront fees where you just pay once and that's it, upload, and then you're done. And then there's backload or and we could definitely dive into that, but basically that one-time fee is paid with that $250, and then every payment after that could be whatever amount that you want. It could be $50 a month, it could be $100 a month, it could be whatever it is that's in your budget. But that first initial, when it comes to like investment products, whether it's retirement accounts or 401ks, IRAs, and things to that nature, it's just $250. That's the cheapest one. And it just makes more sense because you don't have to pay any fees once that account starts to accrue in interest and grow in value. Now, running back to what I said before of investing in yourself, life insurance is affordable. Understand that's a step in investments. As far as like whole life insurance, some would consider that to be the safest investment just because it's not correlated with the market. Regardless of what the market does, it continues to increase in value, right? So that's why I also recommend that for your son. like that, it's a win-win for him. He can't lose. And that right there, I mean, there's policies available at, as low as $10, I think the lowest I sold the policy for was like maybe like about $9 or $10 per month. And mind you, whole life versus term policies are very different. But when you're talking about young kids, and like the price is fairly similar. But yeah, investments typically start around $250 initially, and then from there it could be whatever increment. But yeah, it's definitely doable. Anything else? Alrighty. Well, once again, it definitely was a pleasure, speaking with you guys and, having some time to fellowship. And before we wrap up, so we're going to have a giveaway. Now, Christina, feel free to chime in and just like slap my hand if I'm not doing this the way that you want me to do it. But basically what I was going to do is I was just going to have a trivia question based off the information that we've discussed. And then whoever pretty much got the answer right got the gift card.
I'm okay with that.
Okay. So who can tell me the 5 basics of investing? I'll help you guys out a little bit.
Don't cheat for him.
Okay, boom. Or better yet, who could tell me one?
Discipline.
Boom. All right. Well, sir, that's correct. Discipline is probably the most key. I guess, is that a word? Most key? Major key, rather. Just because everybody's going to be tied emotionally to their money. It's just what it is. It's part of the nature. But just rest assured that the plan that you developed is going to work. Okay. Now, sir, you are going to be the winning recipient of a $25 Red Lobster gift card.
All right.
Yeah, so definitely congratulations to you, okay? And then definitely enjoy it.
I appreciate all the information you handed us today.
Hey, not a problem.
Well, congratulations. We truly appreciate you once more, Mr. Brown. Thank you, thank you, thank you. AB is, I think, who ended up winning. So we are truly excited that we were able to partner to give you an opportunity to win a Red Lobster gift card. So reach out to me. Reach out to me when you have time at info@moreformore.org, and we will get your mailing information so we can get that sent out to you.
All right, I got you. Thank you.
You're welcome. Thank you so much, everybody. Once again, thank you, Mr. Brown, and have a lovely, safe, happy Halloween for those who have children. Enjoy your time. Thank you, and we will be reaching out to you.
Hey, y'all do the same. Thank you so much. It's been a pleasure.
Thank you.
All right,
Thank
have
you.
a good one, everybody.
All right, y'all do the same. Take care.
Bye.